Morgan Stanley just told investors, you can't have your money back. They capped withdrawals on a $7.6 billion private credit fund after investors tried to pull nearly 11% of the fund in a single quarter. But here's the thing. Morgan Stanley isn't even the first. They're the third. And the former CEO of Goldman Sachs says this smells like 2008 all over again. So let's talk about what private credit actually is, why $3.5 trillion of it is sitting in the shadows, and why your portfolio might already be exposed, even if you've never heard the term. Okay, so private credit, in plain English, is when companies borrow money not from a bank, but from a private fund. Think of it like shadow banking. These funds raise capital from pension funds, endowments, wealthy individuals, and increasingly from everyday retail investors. Then they lend that money out to mid-sized companies, usually at higher interest rates than a traditional bank loan. This market has exploded. It's grown fivefold since 2008 to roughly $3.5 trillion globally. And here's the structural problem that makes it dangerous. These funds lend money out in loans that last 5 to 7 years. But they offer investors quarterly redemptions, meaning you can theoretically ask for your cash back every 90 days. So what happens when everyone asks at the same time? You get exactly what we're seeing right now. This didn't start with Morgan Stanley. It started with Blue Owl Capital back in February. Blue Owl permanently ended quarterly redemptions on its OBDC2 fund and executed a $1.4 billion fire sale of assets to give investors a one-time 30% payout. Their stock crashed 10% in a day, and peers like Ares, Blackstone, and KKR all sold off 5 to 6% in sympathy. Then Blackstone's flagship BC Red Fund, the largest private credit fund in the world at $82 billion, got hit with record redemption requests. Investors tried to pull 7.9% of the entire fund. That's roughly $3.8 billion. Blackstone met the requests, but they had to expand a tender offer and have employees personally step in to cover the gap. Sound normal to you? Now Morgan Stanley. Their North Haven private income fund received redemption requests equal to 10.9% of shares, but only honored 5% because of a quarterly cap. That means over half of the investors who wanted out were told no. They returned just $169 million of the $369 million requested. And JPMorgan is watching all of this and quietly pulling back. They just marked down loan portfolios held by private credit clients, specifically software company loans they think AI is about to destroy. And they're cutting the leverage they extend to these funds. When the biggest bank in America starts reducing its exposure, pay attention. Here's where it gets really uncomfortable. The Bank of England's Governor Andrew Bailey has publicly warned that private credit lenders are doing the same type of financial engineering that banks did before 2008. Complex structuring of risky loans with loose covenants and hidden leverage. Former Goldman Sachs CEO Lloyd Blankfein said, quote, "It sort of smells like that kind of a moment again." Jamie Dimon, the CEO of JPMorgan, used the word cockroaches, as in, when you see one, there are usually more. And the data backs it up. The headline default rate in private credit is below 2%. But the shadow default rate, companies that are technically current but showing clear signs of economic stress, has hit 6.4%. That's more than double where it was in 2021. Payment-in-kind income, which is when a borrower pays you in more debt instead of cash, has spiked from 4.2% of fund income pre-pandemic to 8.8%. That's not income, that's an IOU. Now here's the regional bank angle. Banks have about $1.14 trillion in loans to non-bank financial institutions, which includes private credit funds. JPMorgan can eat a $170 million loss on these exposures and barely feel it. That's 0.8% of quarterly profit. But regional banks, they're reporting similar losses that eat up 20% of their quarterly earnings. That's the difference between a paper cut and a stab wound. So here's what I'm watching. First, more gates. If another major fund caps redemptions in the next 30 days, that's a pattern, not an anomaly. Second, regional bank earnings next month. Listen for any mentions of NDFI exposure or private credit markdowns. Third, the Fed meeting next week. If Powell acknowledges financial stability risks from non-bank lending, this story goes mainstream overnight. The bears say this is 2007 all over again and the cockroaches are just starting to crawl out. The bulls say private credit is fundamentally different from mortgage-backed securities and that the system is better capitalized. I'll let you decide, but I will say this. The last time this many smart people said it smells like 2008, it turned out to be 2000. If you want to stay ahead of this story, subscribe and hit the bell because I'm going to be tracking every fund gate, every regional bank filing, and every Fed comment on this. Drop a comment. Do you think private credit is the next big crisis, or is Wall Street overreacting? Let me know. See you in the next one.